We're going to talk about the taxation of group life insurance plans. So, and employer life insurance. So what this means is if you are employed somewhere and there is a life insurance policy that every single person can access. So if you want to check out my other video on group life insurance, then I'll post the link in the video or in the description for the group life insurance video. But essentially, it's if you work somewhere, there's a plan that everyone who works in the company can participate in. And usually it's a smaller face amount policy, and you only have it while you're employed and the employer owns it. So since the employer owns it, they pay a premium on every employee. And if the employee dies, then the employee can name the beneficiary of that death benefit. So since the employer is not really benefiting from it, in terms of them receiving any of the money if the employee dies, it's strictly a benefit for the employee and their family, which means that the employer can actually write off the premiums on their taxes. So those premiums are tax deductible for the employer, which means that it can be counted just the same as a wage. However, the employee does not have to report it on their taxes as an earned wage unless the employer is paying for a policy that has a face amount greater than $50,000. So I'll kind of get into a little bit of an example how this works. I hope I don't really bore you here. But say the employer has 100 employees and he pays $30 a month on each person. 30 times 100, that's 3,000. So 3,000 times 12 in a year is 36,000, right? So if he has 100 employees, each is $30 a month, that's 3,000 a month for 12 months. It's $36,000 a year that he's spending on the life insurance premiums for those 100 employees in that group policy. And if they die, their named beneficiaries are getting the money, not him. So those premiums are now tax deductible to the employer, which means that say the employer makes, $1 million, it's $1 million minus 36,000, and that's how much is taxed on his income. So he can actually take, well, this is what I made, but I'm going to take away the 36,000. That's going to deduct from my taxable income. That's why they call it tax deductible, because they mean you can, whenever you have money that's tax deductible, it means it can take away, you deduct from your taxable income. So you'd only be paying income on whatever his income is minus the 36,000. So that's the amount that's total tax, right? Easier example, say he makes $100,000, but he says, well, I made $100,000, but 36,000 of it I spent on life insurance premiums for my employees. So the remainder, I think, is $64,000, right? $100,000 minus $64,000. So now the employer is only going to pay tax on $64,000 instead of the whole $100,000. And his employees do not have to pay tax on it as if it's a wage. They don't have to report it on their income, on their taxes, because the premium, as long as the death benefit, is less than $50,000, or it's $50,000 or less. The max it can be is $50,000. Now, when the business benefits, premiums are not tax deductible. So if you look at my channel, you're going to see things like buy-sell agreements. You're going to see key person insurance, stock redemption, entity purchasing, stuff like that. So the way that works is when the business buys insurance on its employees for the business to benefit directly if that employee dies. Now, that's usually to take the case of maybe there's two people who own a partnership and one dies, and they want to make sure that, hey, if either one of us die, that we can buy out your portion of the business. Or maybe there's a key person in the company where, say I was a key person in a company and the company had a key person insurance policy on me and I die. That way they can replace the revenue I generate for the organization and also train someone to take my position, because it's a loss of income for the business in both ways. Since the business, though, is actually benefiting from the death benefit, they can't write those premiums off. So businesses cannot write premiums of life insurance where they're the ones who are actually benefiting from the policy. All right. So if that's too confusing, please drop some questions in the comments box, and I'll try to help clarify that. But really, the way you want to look at it is if the business is not benefiting from if the business isn't benefiting from it, if they're not getting the cash value or the death benefit, then they can usually write off the premiums as being tax deductible. So it's a tax incentive for the employer to get insurance on his employees. Now, cash value in either situation, whether it's an employer-owned, whether the employer is benefiting from it or not, cash value is taxed the same way. So the cash value grows tax deferred, and it's only taxed when it's surrendered, and meaning they take out the full amount of the cash value, or when they surrender more cash value than what they've paid in for premiums. So let's say there's a death benefit. So let's say there's a cash value of $3,000 in the policy, but they've only paid in $2,000 in premiums. Well, that means that anything above and beyond $2,000 that they withdraw from the cash value that they surrender from it, they will have to pay taxes on. Okay, and the excess, they pay tax on the gains. That's usually how it works. And the death benefit is income tax free. So whether it's the employee's family receiving the death benefit or the business itself, the death benefit is actually income tax free. The death benefit is treated the same way. It's not subject to income tax. So I hope that helped you understand how business, employer, group life insurance and employer plans, when an employer gets a policy on its employees, I hope that helped you understand how the tax implications are handled on those policies. If you'd like to learn more about life insurance, if you want more about group life, then just check out this video coming up here, and it'll go over that for you guys. Thank you.